For the first time in decades, the United States, the world's biggest economy, was officially downgraded by one of the last major credit rating agencies, still giving us a perfect score, Moody's. Now, this isn't just some Wall Street headline for financial insiders. This downgrade affects you, your retirement, your Social Security, the cost of everything from groceries to car loans. So if you felt like your money isn't stretching like it used to, or you're worried about the future of your benefits, you're not alone, and you need to hear what's going on. Before we get into the details, let me know in the comments, are you feeling the squeeze lately? Is your money going less far than it did a year ago? And if you're new here, please hit that subscribe button. This kind of content really helps people stay ahead. Alright, let's get into it. Chart decreasing. What just happened? The US credit rating was just dropped from AAA to AA1. Sounds small, right? But that's like going from a perfect credit score to still good but no longer flawless. That small downgrade sends a big message to global investors. The US might not be the sure thing it once was when it comes to paying its debts. Bar chart. Why this matters. When trust drops in the world's most powerful economy, ripple effects follow. Interest rates may rise even higher, making it more expensive to borrow, for the government, businesses, and yes, regular families. Think higher mortgage rates, more expensive car loans, and credit card APRs going up again. Even your local small business could feel the pressure. How did we get here? This isn't just about one president or one policy. It's years, decades, of growing debt and shrinking political will to fix it. Right now, the U.S. national debt is over $36 trillion. That's so big it barely feels real. But if we broke it down, every American would owe about $100,000. A family of 4? Nearly $400,000. You won't get a bill in the mail, but it does show up in other ways. Like this, right now about 13 cents of every federal dollar is spent just to pay interest on that debt. That's before we touch Social Security, Medicare, schools, or defense. Imagine 13% of your paycheck going straight to your credit card's interest, not the principal, just the interest. That's what we're dealing with nationally. Bank crowding out the economy. Here's where it gets worse. When the government borrows more money, it's competing with everyone else. Families, students, homebuyers. That's called crowding out. It can slow private investment, stall job growth, and flatten wages. Old woman who does this hurt most? If you're retired or close to it, you already feel the impact. Gas is up. Groceries are up. Medical bills are up. But your income? If it's fixed, like from Social Security, it's losing value. And here's the scary part. Social Security and Medicare are the biggest expenses in the federal budget. That's not opinion, it's math. These programs are funded by taxes from today's workers. But our workforce is shrinking, and our aging population is growing. So when Congress starts talking about how to fix the debt, guess what lands on the chopping block? Programs like Social Security. Prohibited. Why it's not getting fixed. But here's the problem. No one wants to touch it. Politicians avoid the topic like the plague. Because cutting Social Security is a political landmine. Raising taxes is too. So instead of making hard choices, leaders on both sides kick the can down the road. But that road doesn't go on forever. Moody's didn't just downgrade us for fun. They warned, the U.S. is trapped in a cycle of giant deficits, no meaningful reforms, and rising interest payments. If we don't change course, the debt becomes unmanageable. Dollar banknote, can't we just print money? Some people say, why not just print more money? Technically, the US can. But printing money to pay off debt without fixing the problem causes inflation, something we've already seen. Inflation makes your dollar worth less. It hurts people on fixed incomes. It forces the Fed to raise interest rates again. And when rates go up, our debt payments grow even more. It becomes a vicious loop. Hot face real-world effects, for you. So what does all this mean for regular people just trying to make ends meet? Higher interest rates on credit cards, homes, and auto loans. Slower growth in your retirement savings. Weaker dollar, meaning more expensive imports. Pressure on Social Security and Medicare, the programs millions depend on. Even if you don't follow the economy, you've probably felt it already. Rent is up. Groceries cost more. Maybe your 401k took a dip and didn't bounce back. Globe showing Europe-Africa global consequences. When trust in the US drops, other countries notice. Investors might look elsewhere. That weakens the dollar, drives up the cost of imported goods, and adds more stress to the global economy. And because the US dollar is the world's reserve currency, our economic troubles affect everyone. Abacus, what you can actually do. Let's bring it home. What can you do? Stay informed. Understand how policies affect your money. If nearing retirement, talk to a financial advisor. Cut high-interest debt. Interest rates aren't coming down anytime soon. Build an emergency fund. Flexibility matters in uncertain times. Use your voice. Contact your representatives. We need leaders who make hard decisions, not easy promises. Handshake, we're all in this together. This isn't just about politics or markets, it's about people. Seniors, families, young workers, everyone deserves a future where the system is fair, sustainable, and secure. So, let me know in the comments, are you worried about Social Security? Has inflation changed your daily habits? I read every single comment, and your voice helps others feel less alone. If this helped, hit subscribe. We've got more updates coming to help you stay ahead of what's next. Thanks for spending this time with me. Take care of yourself, and I'll see you in the next one. Television channel tagline. Stay smart. Stay secure. Stay subscribed to Social Security Solutions for updates that hit home.